Hi, this is Steve from digrashka.com. This video will tackle the Iron Condor setup and its profit and loss diagrams. The Iron Condor setup is an option combination for a relatively neutral outlook. Selling an Iron Condor typically involves the simultaneous selling of an out-of-the-money call credit spread and an out-of-the-money put credit spread. Examine the chart on the left-hand side. A short Iron Condor would typically involve options bought and sold at 4 different strike levels. Strike 1, representing the lowest strike price, and strike 4 being the highest. The order combination goes as follows. You short a call at strike 3, you long a call at strike 4 as the hedge, and you short a put at strike 2 and long a put at strike 1. Once again, you do Iron Condors having a neutral outlook. Your expectation is that the market does not move over your short strikes. Condors are adjustable depending on outlook. Normally, the Condor will be set with a spot price between 2 contracts sold. Should you want to be a bit more bullish or bearish, you can adjust the spot nearer one of the strikes you sold. Your max win is the net premium collection as option seller of the risk involved between strike 1 and 2 and between 3 and 4. Should price expire between strike 2 and 3, your whole position worked according to your expectation and is out of the money at expiry. This is the situation where you get to keep the whole of the net credit received. You will observe that the broker holds margin only on one side. The price can only be at one place at a time, and your max risk is one side of your Iron Condor is attacked and you pay for the call or the put side minus the net credit received. In a formula, max risk is the difference of the strikes times contract price minus the net credit received up front. Iron Condor is, with the right conditions, a great way to collect more credit. You have margin held on only one side of both sides that you sell, and you collect 2 times the premium on both sides. The difference of an Iron Condor from a strangle is that an Iron Condor is hedged and therefore risk defined. The break-even price is at either the in-the-money call strike plus the credit received or the in-the-money put strike minus the credit received. It's best to capitalize on this strategy when the IV is high. Just make sure that the strikes you choose are far enough not to get hit. You'd also want to take into consideration that an Iron Condor does narrow your chance of win as compared to a credit spread where you sell and answer for a one-sided market risk. Depending on your hedge, this strategy is risk defined and can be used with smaller trading accounts. Lastly, as a seller, you capitalize on theta decay and high IV environments. Iron Condors set up with a wider strike difference gain more advantage than tightly set Iron Condors.